Okay, we'll now take a look at exercise 20-2 on page 1222. Here we have a change in accounting principle. Now remember, we'll account for those retrospectively, meaning we'll go back and restate any prior year's financial statements that are being reported with this year's financial statements, as if this particular principle had been applied all along. The example I mentioned in the lecture video there was a change in inventory methods. Here, Aquatic Equipment Corporation decided to switch from the LIFO method of costing inventories to the FIFO method at the beginning of 2016. Now this change, you guys, is a change in an accounting principle. And it's one that can be accounted for retrospectively, meaning we can go back and restate prior year's financials that are being presented with this year's or comparative financials, because we are changing from LIFO to FIFO. Well, we would have the information to do that. If you're going the other way, you'd need those LIFO cost layers. So if we were changing from LIFO to FIFO, it'd still be a change in accounting principle, or LIFO to FIFO is a change in accounting principle that can be accounted for retrospectively. If we were going the other way from FIFO to LIFO, we would probably have to account for that one prospectively, because the retrospective approach would be impractical. So we're going with A here, falls into that category. We'll revise the financial statements, the ones from prior years, adjust the account so this year's statements reflect the change in accounting principle, and disclose the change from LIFO method to FIFO for inventories in the notes to the financial statements. So they ask us, or let's read through it. Aquatic Equipment Corporation decided to switch from a FIFO method of costing inventories. Decided to switch from the LIFO method of costing inventories to the FIFO method at the beginning of 2016. Keep wanting to call them the wrong names, you guys. The inventory as reported at the end of 2015 using LIFO would have been $60,000 higher using FIFO. Okay, retained earnings at the end of 2015 was reported to be $780,000, reflecting the LIFO method. Tax rate's 40%. Okay, they want to know, number one, calculate the balance in retained earnings at the time of the change, the beginning of 2016, as it would have been reported if FIFO had been used in prior years. So if FIFO had been used all along, what would our balance have been in retained earnings at the beginning of 2016? Well, they tell us our retained earnings balance at January 1, 2016, using the LIFO method, which is what they used, was $780,000. Now they're switching to FIFO, and they want to go back and show this balance at the beginning of 2016 as if FIFO had been used going into that year. What they're saying is inventory reported at the end of 2015 or beginning of 2016 using LIFO would have been $60,000 higher using FIFO. Alright, so they're saying the inventory balance would have been higher by $60,000 under FIFO. What you got to remember here, you guys, is when you're dividing up the cost of inventory, it can only go into two piles, whether it was purchased or manufactured. That cost can only go into two piles. The asset account, the current asset account inventory, or it's going to go into cost of merchandise sold or cost of goods sold. Okay, so if they say inventory at the end of 2015 would have been $60,000 higher had they been using FIFO rather than LIFO. Well, if inventory would have been higher, that means cost of goods sold would have been $60,000 lower. That would have been less deducted in coming to our income number. Right, so our income number would have been higher. Remember, net income increases retained earnings, so the retained earnings balance would have been higher, but not by the full $60,000. We'd have to take into account the income tax effect of 40%. So we'll start with the retained earnings balance at the beginning of 2016 using LIFO was $780,000. Okay, so what are we saying here? Our retained earnings balance at the beginning of January 2016 using the LIFO method was $780,000. A few things to remember here. Retained earnings, when the business begins, the balance is zero. This number is increased by net income, decreased by net loss, and dividends. Okay. Here, they're switching methods from LIFO method of inventory to FIFO, and they know that if FIFO had been used all along, the inventory balance would have been $60,000 higher under FIFO at the end of 2015, beginning of 2016. That means if inventory was would have been higher under FIFO, cost of goods sold would have been $60,000 lower under FIFO. There's only two piles for the cost to go into, either into inventory or it's going into cost of goods sold. So if inventory was higher than expected, cost of goods sold would have been lower under FIFO if inventory was higher. So under FIFO, pre-tax income would have been higher by $60,000 because we had $60,000 less to deduct in cost of goods sold. Okay, now we want to deduct from that less income tax of 40%. Well, that equals negative 60,000 times 0.4 or 24,000. So what we're going to say is the cumulative net income, or net income over this period of time, and therefore retained earnings would have been higher by 36,000. The difference in the $26,000 increase in pre-tax income and the 40% income tax rate that would have been charged on that pre-tax income. So net income in effect would have increased by $36,000 over this period of time, and so would retained earnings. So we'll add that to our beginning retained earnings balance. And this gives us our retained earnings balance at 1/1/2016 using FIFO. So we made the conversion there, you guys. Now that's what we would need to, let's look at our chart again. We revised comparative financial statements. We'll change that balance to start 2016 to what it would have been under FIFO. We now need to adjust the accounts. We'll do that through a journal entry, and we would disclose this change from LIFO method to FIFO method in the notes to the financial statement. Also, something else we should probably point out with this one. The reason a lot of large businesses use LIFO is they get a tax break under LIFO, right? If prices are going up throughout the year. If prices are going up all year, then under LIFO you include the higher priced items purchased or manufactured at the end of the year in cost of goods sold, lowering that year's pre-tax income, and in effect lowering that year's income tax expense. But this switch back to FIFO increased prior year's net income. It's going to cause them to pay some extra income tax. It's not really a part of this problem, but I thought I'd mention it anyway. Now that's all of instruction 1, determining that retained earnings balance at the beginning of 2016 if FIFO had been used in prior years. And number 2, we got that on a separate tab here, but it asks you to prepare the journal entry at the beginning of 2016 to record the change in the accounting principle. All right, so let's go to our journal page. Okay, and this entry would be dated January 1, 2016. Well, what's going to increase? They tell you that right in the exercise itself, right? Our asset account inventory increased by 60,000. Okay, if we go back, but retained earnings increased by 36,000. Remember, retained earnings increases on the credit side. And this change has also increased what we owe to the IRS. So we're going to credit income tax payable for that difference, which we have over here, $24,000, right? Alright, now that takes care of exercise 20-2, and again, that's an example of how you'd handle a change in an accounting principle. Thanks a lot. If you have any questions, please be in touch.